Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. Just a quick note before we dive in. The information that we share is meant to educate and inspire, not to serve as personalized financial advice. Everyone's situation is unique, so be sure to consult with your own financial professional for guidance that fits your life. And just so you know, the opinions shared in this podcast are my own and those of my guest, and they don't necessarily represent those of any organizations that I'm affiliated with. For more important disclosures, please go to our webpage at pearlplan.com. Now, let's get started. Welcome back to the Women's Money Wisdom Podcast. Today, we are going to be talking all about mortgages. And I know that's a topic that affects many of you, whether you have a house today, you are looking to protect your low interest rate or reset your high interest rate, or you're looking to buy in the future. This is going to have a wealth of information for you and your friends. And back on the podcast is friend of the pod, Erica Powers. Erica is a mortgage professional, and she has been assisting clients across the country with their mortgage needs for over 20 years. She is a certified divorce lending professional, so she has expertise for people going through a divorce that may need a new loan. And she's also a certified mortgage planning specialist, and she has been a wealth of wisdom over the years. Welcome back to the podcast, Erica.
Thanks for having me, Melissa. I'm excited to be back.
Well, it's always great to chat with you. We talk all the time because you're kind of my go-to person when I need information about mortgages, both the how-tos, the what's possible, but also the what's advisable, because those can be two different things. We're recording this on April 8th, and the episode's coming out in a couple weeks. And because we're in pretty volatile times, we can have a lot of changes in the next 2 weeks. So I just want to give you like a little line in the sand about when we're recording this conversation. And none of the things that we'll talk about are like, quotes, for example, or anything like that. But we're going to give you a lay of the land, something we've been planning on even before the turbulence in the market in the last few weeks. But I think it's the perfect time as things are changing significantly to talk all about mortgages, how to borrow, when to refinance, all that good stuff. So what are you seeing today, Erica? Give me a lay of the land of, kind of the real estate market, mortgages, what you're doing, what you're not doing. Like, give me some bullet points about what's going on today.
Sure. So I can help clients all over the country, but I do mostly assist clients in Washtenaw County and the surrounding areas, so Southeast Michigan. So saying that, because we are still in our area seeing a shortage of inventory, right? So people are competing for most of the houses that go on the market. So we're seeing a lot of that competition, and we're still seeing rates that are maybe higher than people got used to a few years ago. And so there are a lot of people, I think, that maybe had been previously sitting on the sidelines hoping that we'd see rates come down. But I do think that we've seen a lot of people decide that that may not be what's going to happen. And so if they're interested in buying or getting into the market and looking for a house.
Yeah, I work with people all over the country. So about half of my clients are here in Michigan, half my clients are all over. And it's definitely a time period where everybody's real estate market is not the same. I recently read that the housing market in the Midwest and the Northeast is quite tight. There's not a lot of inventory. There really wasn't like kind of an overbuild, oversell. It just is an area that hasn't been as intensively focused on growth. But then in certain parts of the South and Southeast and maybe a portion of the West Coast. There's a little bit for a variety of reasons, including, natural disasters, unfortunately, has soured people on Florida. It's much more difficult to insure a house in Florida or California. And then some parts of the country just had like kind of parabolic, like just through the roof prices, and they're coming down to earth. And so that's changing the economics. So it depends on where you're listening as to what market you're in.
Yeah, 100%.
So then you said interest rates remain relatively high. We had this very, very low interest rate situation after years of relatively low rates, lower than they are today, right? So when COVID hit, certain people can brag about a 2%, 2.5% mortgage. And nowadays we're talking in the sixes and sevens, right?
That is correct. Last week, we saw a little bit of a correction for about a day.
For a moment
And
in time.
for a moment in time. And now this week, rates have gone back up again. So now historically, they're still lower than they've been in the past. So I don't want people to think that, if you look at a historical graph, we're still kind of in the average or a little bit low average over time, but it's still higher than people got used to.
Yeah, that is, that's a big, huge portion of your mortgage payment when interest rates are where they are today. And then we also, at the same time, have dynamics where property values are going up, property taxes are going up along with them, and then homeowners insurance, for better or worse, like you want that insurance and it's just getting more expensive because the equation of the property values plus losses that insurance companies are taking on storms and maybe a little bit of piling on or, kind of sneaking in your rates along with it. Like these are all very real parts of the equation for affordability of housing.
Yes. I do find too, a lot of times people will be looking on, any of the websites, zillowrealtor.com, whatever it may be. And some of the amounts that they're listing as what they think the homeowner's insurance will be monthly is not even close to where it will end up once that client gets a quote. So it's important to kind of build a padding into that number because that will be a part of your monthly payment.
That's right. And also, if the person whose house you're buying has owned that house for a long, long time, they may have a low and unsustainable property tax that is going to be reset when you purchase. So you can't count on, somebody that owned a house 20 years getting the same range for the property taxes. It's going to be higher. You need to look at comparing the person across the street that sold their house last year and not necessarily that owner.
Yes, you definitely need to take into account that those taxes are going to go up. And make sure that when they do go up, that that's still going to fit your budget.
I also think another important consideration, I know some people just walk in the door and they're like, well, here's all the things I'm going to change in this house because, it is my dream house, but also my dream house has this color walls and this type of flooring and the kitchen needs to be redone, etc. And gosh, I wish I lived in that family because my husband's like no changes in the first 5 years, kind of. But you really need to think about that equation too, because lending is the same when it comes if you needed to do a home equity line or, we were thinking about materials in a time of tariffs. So even if you could have, redone a bathroom for 25,000, let's say a powder room for 25,000 a year ago, it might be 40 or 50,000 for the same project because of the cost of materials that are not all made onshore here in the US. And so there's a lot of factors that you can plan for going in as you're selecting your house. And if you're going to have a home improvement project, you really need to budget that in right up front.
Yes. And to realize that you may be being very unrealistic about the cost. So it's a good idea to do a little bit of research about what the cost actually will be. And then also to factor in a little bit of a buffer for things that might break in the house. So for a lot of people that they're buying their first house, they don't realize that as a homeowner, if it breaks, it's on you to fix it. So you need to have a little bit of a cushion there to be able to make up for any of those costs that might unexpectedly come up.
Yeah, I'll tell you, in my financial planning software, there's a space for maintenance, and you could also include if you bought a condo, the homeowners association costs, which can be quite high, but they cover a lot of things that you may otherwise really be paying for, like landscaping, any exterior improvements, a host of services. But I often start with a baseline of 1% of the value of the home. So if you bought a $750,000 house, I would say at least annually you would expect to do maintenance of at least 7,500, if not more. And so that would be a conversation point, but it's not like, when you rent and you can just call the landlord to fix things. You got it. That's on you. And there are certain things you need to replace and change over time.
Yeah, 100%. So it's good to have that cushion so that when those things come up, you're really not caught off guard.
One of the reasons that I wanted to record this episode is that we had a mutual client who had asked, like, why aren't I know the Federal Reserve lowered interest rates. Why aren't mortgage rates lower? And there are so many factors that go into mortgage interest rates that they're not just saying, hey, is the Federal Reserve going to lower by a 0.25% or 0.5%? And thus, that's what rates are going to be. How frequently do rates change?
Rates change honestly every day and sometimes throughout the day. So, you could talk to me in the morning and the rate might be one thing at that point in time. And then you make a decision in the afternoon, the rate could be different. Oftentimes we do see our rate sheet stay the same throughout the day, but it's never a guarantee. And our rates don't change just based on the Fed rate. So that's kind of a misnomer. Oftentimes people will call us and say, well, the Fed lowered the rate yesterday, so the rates are lower today. But our mortgage rates probably had priced in that change by the Fed much earlier before the Fed actually even changed the rates.
Weeks and months in advance.
Yes. Yes. In sometimes on the reverse, if we think that they're going to change the rate or we think they're going to change the rate by more and they don't, then that can actually harm our rate, even if they still lower their rate. But our rates factor in many different things. So it takes into account inflation. It takes into account the 10-year treasury. It takes into account other things that might be happening either politically within the United States or outside of the country, right? So the threat of war or instability, those types of things are going to impact mortgage rates. So it's not just one thing that impacts them.
That's so interesting. I often ask you how rates have changed when I see the bond market as measured by often the 10-year treasury. When I see that going up or down, then usually there's often a pattern or a rhyme because bond markets are listening to the same thing. We have so we mentioned we're recording right after the first week of April. The first week of April, we had historically significant down days. The stock markets were down 10%. And for the first 2 days, bonds really were acting like the seesaw that we described, where stocks were going down and bonds, their prices were going up, which meant their rates were going down. But then we had the third day of, kind of instability where things weren't as bad, but they were still negative. And on that day, interest rates actually went up and the price of bonds went down. And there is speculation. Why is this happening? And some hypotheses are maybe China's selling some of their bond reserves that are in U.S. Treasuries. Certainly, if we have tariffs that are not going to go away, that's inflationary in terms of the prices. And what the Federal Reserve does to fight that is make interest rates higher. Or, just simply things might go back to normal, which would be kind of put us back to where interest rates had been before. All of these are possible, and all of these are being factored in to a bond market that has a variable and changing price and is not predictable, even though people try to predict what's going to happen next all the time. So
I
how do you,
wish we could predict what was going to happen.
right? It really would make everything easier. And that is such a stressor and adder to, most people don't professionally buy and sell houses all the time. It's a transaction that typically happens two, three, four times in your life. And so adding the stress and anxiety of a variable interest rate and types of loans and things like that to your considerations when you're purchasing a house can really make you feel a little bit more uncertain and have, just more variables you're not experienced with.
Yes. I think that all of the different variables when you're buying a house adds to that stress. And I do think for my clients that are right now trying to figure out, do I buy a house? Do I wait? What do I do? It's really to look back and figure out where their budget lies. If they're buying a house today, are they going to be able to afford the house based on today's rate? And will that fit their budget? If that's going to fit their budget, especially in the area where we're at, where house prices continue to increase and are forecasted to continue increasing, then you buy the house when you find the house that fits your budget and the rates are where the rates are at. And then later on in the future, if rates come down, that's when we have the opportunity to look at refinancing. But at least you're not paying more for the house because you waited till rates came down and maybe you get a better interest rate, but your house is a lot more expensive at that point.
Yeah, that's true. There's so many just variables. And what we always do, if people can afford it, is encourage them, if they feel ready and it's the right time to, yes, do it, but then also have the right game plan in place to evaluate. And so that game plan would include, I know that for you, any loans that you've done in the last few years for clients who have the potential to refinance, you've got your list, you know what their interest rates are. So you can kind of calculate, hey, these 20 clients need a phone call when interest rates go lower.
Yeah, and that it's going to make sense, right? So if you're going to refinance, you want to make sure that the rate's going to be low enough to recoup any costs and that it's going to make sense over the long term, right?
So when you say low enough to recoup any cost, you're saying like if a rate were an eighth of a point lower. So if you went from 6.5 to 6.25, let's say, so 0.25 lower, that might not be enough to make up the cost because you also have closing costs and you're resetting. If you did a 30-year to a 30-year, you have a whole new 30 years to pay it off.
Yeah, most likely that small of a decrease is not going to make a benefit.
What's the
So,
typical range where people might want to reach out? Like how much lower?
I mean, a lot of people will use like a 1% um, gauge, but you do have to kind of take into account loan size. So for some people that have a larger loan, it might not take a full percent before it's going to be a benefit to them. So, I think it's a case by case basis. And that's why it's a good idea to have the discussion with your loan officer, make sure that they're paying attention and watching for you, and have the discussion of what's going to make sense. So when they call you and say, today might be the day, and it only might be today that's the day, you're ready to move forward.
And what would the cost be in a refinance? And also, I know sometimes people say, oh, this is no cost, but the cost might be buried in the interest rate in that case.
Yeah, if you're hearing that it's a no cost refinance, usually that means that the rate that you're choosing has some type of a credit built in that's covering the cost. Because the costs to refinance are including whatever the lender may charge you. So whatever their fee is, typically to cover things like underwriting or processing fees. But then there are also fees if you need an appraisal. You're going to need to pay the appraiser. You're always going to have title work that needs to be done. And there are fees that the title company is going to charge to prepare the documents for the time that the notary is sitting with you signing the document. Depending on the state you're in, sometimes there's taxes and things on a refinance where you're going to need to pay that locality a certain amount of taxes. So you need to factor those in. So there are a range of fees that need to be calculated in depending on where you're located at.
And is that something that when you're talking to somebody about refinancing, you can tell them, hey, here's an estimate of what the cost might be, and here's your new payment schedule.
Yes. Yes. We would discuss in detail what the cost would look like for their specific situation. And then based on the new payment, how long does it take to break even on those costs to see a savings?
Perfect. And if you need to be on one of those lists, call the person who did your mortgage, or if you don't have a person, Erica, I'm sure would be happy to be watching for the refinance moment.
Yes. I'm always happy to help anybody out.
So just kind of I want to switch the subject ever so slightly, and think ahead. I hope that current environment, kind of the tariff trap, doesn't create a US recession. I don't think that that's like 100% probability. But when we have our next recessionary environment, which, at some point there will be a recession. The question is when. What changes when it comes to mortgages and mortgage environment? And what would people need to be kind of knowledgeable about?
Well, it depends on, obviously, there's all sorts of things that happen, but typically in the previous recessions that we've seen, it has improved interest rate.
Mhm.
So if that were to happen again and that we saw an improvement in rates, then there might be some opportunity to take advantage of refinancing. This is likely going to be for the people who have purchased a home in just the last few years. Um, your people that are still in the twos and threes of the old days, they may never refinance.
I kind of hope
Unless
we never get to that point because it was created out of a moment of extreme economic stress with COVID. So
yeah,
might be
I
a good
know.
sign if we don't go back there.
I kind of don't think that I will see that in my future again. Um, but I do think that for those people, they're likely not going to be raise financing unless maybe they're looking to do something with the equity in their house. And there could be reasons why that would make sense for some people. But for the majority of people, the ones that have purchased in the last few years, if rates start to come down in the future, then there is a good likelihood of that happening in a recession. And then they would have an opportunity to take advantage of that. Um, so I think it's something to be kind of keeping an eye on and be aware of that would be a benefit. Mm.
Yeah. And I would just add, when you mentioned in the past, interest rates have been lower. If we have a situation where we have both inflation and slowing growth, we don't know. That could be a stagflation like the 70s, and we just don't know where interest rates would be depending on what needed to be defeated more, inflation or kickstarting growth.
Yeah, and I think that's the most important thing to keep in mind is it's not just one factor that's driving the interest rates, right?
Mhm.
It's all of these different factors. So just because we're in a recession doesn't mean that rates are going to improve if inflation is really high. Inflation really affects interest rates, probably more than some of the other factors. So you can't necessarily count on that. And that is why I think it's important for people not to try to time the market because you may not be able to time the market. Um, and so
We
maybe,
probably won't be able to.
yeah. Yeah. So you might be sitting around waiting and thinking that you're going to get to this point where rates are going to be low and house prices are going to drop dramatically. And that's very unlikely to happen. We don't really see that even if we do go into a recession, it would not likely be like what we saw in '08 where home prices came down. We don't expect that.
Yeah, never say never. And certainly there are so many different factors. There's also, factors when it comes to lending standards. So sometimes banks can either be forced due to regulation or because of their own focus on their balance sheet may choose to be pickier about who they lend money to. And that certainly can impact the mortgage possibilities for you as well.
Yeah, there's all sorts of things that are going to impact where rates are at. So it's never just one thing.
Well, I think we might have made things less clear and not more clear, but that's really the nature of the world of mortgage is it's constantly changing. There are also different types of buying programs. And if you could just briefly, like, let's somebody has an adjustable rate mortgage, which is also called an ARM, and they may be coming closer to a reset. Although I think some of those people probably have a few more years based on when interest rates went up, unless they did a very, very short ARM, like a 3-year ARM. But what should those people be looking for?
I think it's the same thing, right? You're going to take a look at where your payment is now, where you think that it might adjust to. Um, when you did your mortgage, there were terms of how much the rate could adjust either upwards or downwards each year. And so I think it's important to call your loan officer and have that discussion of where are you at? What are the possibilities? And then at what point does it make sense for you to maybe lock into a fixed rate mortgage? So, maybe it doesn't make sense right away. Maybe you're hanging on to the arm for a little bit, depending on what's happening in the market. But in other situations, it could make sense even right now to take advantage and to lock it in. But that's where you have to have the discussion because everyone's situation is going to be different, right? And everybody's goals are different and their financial plans are different.
That's absolutely true. And that's why, hopefully in this conversation, you're hearing a financial planner, a really knowledgeable real estate professional, and a mortgage person together can really combine for, the ideas and concepts that can be really informative for you in making the most informed decision when it comes to real estate and mortgages. Is there anything you would leave people with in terms of things that you're seeing that are different or questions they should ask in today's environment about either refinancing or new purchase mortgages?
I think the biggest thing is to have a good plan when you're searching for a house. So if you're a purchaser and you're searching for a house, have a really good plan and be knowledgeable about depending on where rates are at or where they might move as you're putting in offers, will you still be within your budget? So if you're able to do some of that research and have those discussions ahead of time, then when you're putting in an offer, you're going to be more confident regardless of where the rates are at. So I think that that's number one is to just have a good loan officer that's working up those numbers for you. And so that you're going into your offer with confidence. And then I think for refinancing, it's kind of the same thing, right? Are you having that discussion with where it's going to make sense for you? Knowing how long you're going to live in the home and, what your goals are is going to drive your decisions. So that when you do see a rate change that you're able to take advantage.
I love that. I think that you can really do a lot of pre-planning to be prepared, especially, with resources like Erica or using financial planning software to put in, hey, this is what we would buy something for. Here's the interest rate. So you can foresee how that will impact everything and also your budget and how much money you need to set aside for the house, including property taxes and insurance and maintenance costs. So do keep your eyes wide open. Do be informed. If you're not sure where to start, calling somebody like Erica, if you're going to be a first-time home buyer, and saying, here's a lay of the land of our finances. Can you tell me what we can afford? Can be really beneficial for you for being prepared. And that doesn't need to be a call the week you're going to be under contract. It can be a call 6 months or 12 months out.
Yeah. I think if you know you're going to plan on purchasing, it's always a good time to have the conversation earlier rather than later.
Well, Erica, where can people find you if they're interested in learning more?
Sure. They can find me. Well, I can give you my website and you can put that in the show notes. And they can also find me on Instagram at local mortgage banker. Perfect. And send me a message. I'm happy to help anybody that's interested in purchasing or refinancing.
Well, thanks for bringing some mortgage wisdom to the podcast, Erica. We appreciate you as always.
Yeah. Thank you for having me on.
Thank you for listening to the Women's Money Wisdom Podcast. If you found value in this episode, the best way you can support the podcast is to forward an episode to a friend or leave a review. Go to pearlplan.com and the podcast link to get all the resources and links mentioned.